Greetings to everyone. My name is Edward, and you can call me Ed for short. Here is pros and cons accountancy tutorials, and you're all welcome. So, as we promised the last time, we made mention that our next video is going to be on the recognition of income tax in the financial statement. That is for taxes to be charged to the profit and loss account or the income statement and the financial position, or what someone will call balance sheet. So the focus is still on income taxes, IAS 12. The last time we talked about income taxes in terms of the current taxes and deferred taxes. We explained that current tax is the tax that we pay on our current profit. And the deferred tax is a tax, or let's say a notional levied, which is on a deferred, a taxable difference. If you remember, we talk about a taxable difference. But our focus was more on the calculation of what the deferred tax. Remember, we said for you to get your deferred tax, you should be able to calculate for your temporary difference. And temporary difference is just the difference between your carrying amount and your tax base. Now, by getting your temporary difference, we apply our tax rate, our theoretical tax rate on it. Then we get what we call deferred tax. If we remember, we also made mention that the temporary difference can be analyzed as to whether we have a taxable temporary difference or deductible temporary difference. If we have a taxable temporary difference, the moment we apply our tax rate or we charge our tax rate, we get a deferred tax liability. The other way around is a deferred tax asset. So today, we want to find out how we will calculate the amount that we will charge in our profit and loss, and also the amount we are charging, we are recognizing in our financial position. So the recognition both in the profit and loss or the income statement and the financial position. Now, for the current tax, because it is tax that we are paying on our current profits, that is what we are paying. So normally, for financial reporting, we are going to see that in the note given to us, the other information given to us, we will see that as a provision in our note. So that is what our current tax. But as I mentioned the last time, there are some adjustments that we need to do if we want to charge it or recognize it in our profit or loss. What are these adjustments? These adjustments is a per year adjustment. So the payment that we made in the previous year, we may have over-provided or we may have under-provided in our profit or loss, or we may have over-provided or under-provided our current tax for last year. Now, if your trial balance is given to you, we have the debit side, or we have the credit side, and we have the debit side. Normally, you will see current tax on your trial balance or deferred tax on your trial balance. If you see current tax at the credit side of your trial balance, then simply it is a liability. It means you underprovided last year, and therefore we are giving you a liability this year for you to settle. That is why it's at the credit. You know, liabilities has a credit balance, so it will be at the credit. If it's at the debit side, assets are at the debit side. So surely it is an asset given to you, you can use it. What does that mean? It simply means that if I have my current tax that I'm paying today, I will just subtract from it. I will just subtract the overpayment or overprovision that I made last year from it. So normally, the amount we are going to recognize in our profit or loss becomes what? The adjusted current tax. The adjusted current tax. Because as I said, if you get your trial balance and the current tax is at the credit side, then it is a liability. So whatever we are paying today, we need to add it up. However, if we take our trial balance and the current tax is at the debit side, then it is what? An asset given to us. It means we over provided last year. So the credit side means we under provided last year, and therefore we need to pay. So whatever we are paying today currently, we just add to it. So basically, that is the idea for the current tax. So what we recognize in our profit or loss, becomes the actual current tax, which is the liability for today. Then we adjust it with either over or under provision. Over or under provision. Then we can get what? Adjusted current tax. So basically, in our profit and loss, in terms of talking about current tax, this is what is going to be there. But the overall amount we are going to charge in our profit or loss is this adjusted current tax plus what? Movement in deferred tax. So surely we are going to talk about the movement in deferred tax. For the current tax, that is the explanation. What about the movement in deferred tax? But before we go to the movement in deferred tax, somebody will also be asking, what should I recognize? What should I recognize in my financial position as a current tax? For your financial position, whatever you have in the note as the current provision becomes what? The liability you are going to what? Recognize in your financial position as current liability. So in that case, what we have at the top here becomes what? Our current liability in the financial position. That becomes our current liability in the financial position. So we recognize whatever we see in our notes, whatever provision that we have in our notes. Here we are talking about financial reporting, right? So whatever we see in the additional notes becomes what? Our current provision, and therefore it becomes the current liability in the financial position. So that is all for the current tax. Now, if we go to the movement in deferred taxes, the last time when we were talking about deferred taxes, we said you can get a deferred tax asset or a deferred tax liability. If it's a deferred tax asset, what do you do? If it's a deferred tax asset, then it means we have an asset, right? We have an asset. So we are going to compare this that we have with whatever we have in our trial balance to be sure if there has been some movement, if there has been a change. Because when we talk about deferred tax, what do we mean by deferred tax? It is accumulated, more or less like an accumulated taxes. So every year we'll be checking what the taxable differences to be sure if our deferred tax has gone up or it has come down. That's how it's done. Every year we check to be sure if our deferred tax has gone up or it has reduced. If we get an asset, then it means it has reduced. If we get a liability, then it means if we get a liability, we will check whether it has gone up or down. So surely, if we have deferred tax in our trial balance, and this deferred tax is at the credit side, what does that mean? It simply means it's a liability last year. It means last year there was a liability on deferred taxes. So what if I do for this year and I get asset? Then it simply means that the deferred tax has moved from liability and has come to what? An asset. It has moved from liability and has come to what? An asset. So let's demonstrate. So let's say in my trial balance, I have the credits and then the debits. So I have a deferred tax of 1,000. And this is coming from last year. It's at the credit side. Once it's at the credit side, it simply tells you that it is what? It simply tells you that it's a liability. Last year, we had a liability. So I calculate this year and I get an asset, a deferred tax asset. So this year I get deferred tax asset of 2,000. Please, this is the trial balance, right? But this year I calculate and I get deferred tax asset of 2,000. Then it simply means that the movement, it has moved from 1,000 down, like from a liability of 1,000 down to what? 2,000 assets. So what is the movement? The movement isn't just 2,000, but the movement is an asset of what? 3,000. Because if it was only this 2,000, if the movement was only this 2,000, then it would have, the movement would just be what? 2,000. But we already had a liability of 1,000, which has dropped down to an asset of what? 2,000. So the movement is what? 3,000. The movement is now 3,000. The movement is now 3,000. So in that case, we will add 3,000. It's an asset. So we will subtract 3,000 from the current tax we are paying today. Let's do another one. If, let's say, the deferred tax asset, or it wasn't a deferred tax asset, but we calculated and we got a deferred tax liability, a deferred tax liability, then in that case, we are going to get a deferred tax liability, let's say a deferred tax liability of 2,000. What does that mean? This is a liability. So what is the movement? The movement simply means that last year it was 1,000. And this year we are seeing it to be 2,000. So it means an increase of what? 1,000. So in that case, the movement is 1,000. Please, this is very confusing. So let us try as much as possible and get it well. Because IAS 12 is one of the easiest things that you can do. And you can do financial reporting and dodge IAS 12. So let's try and get the movement very well. For current tax, it's very simple. But the deferred tax, the only confusing part is the movement. So let us try and get the movement. Once we get the movement, we are good to go. So it simply means that for this year, from previous years are coming to this year, we have a deferred tax of what? 2,000. However, last year it stood at what? 1,000. So the movement is now what? Another what? 1,000, which has come to add up. Let me go back to when it was an asset. When it was an asset of 2,000, meaning the liability dropped from liability of 1,000 and came back to what? An asset of 2,000. So it simply tells you that the asset itself was what? 3,000. Because we had a liability, it has what? Covered the liability of 1,000, and now we have an asset of 2,000. So the movement is 3,000. That is the whole idea of the deferred tax. So if we want to show our taxes or recognize our taxes in our P&L, it is just the adjusted current tax plus the movement in deferred taxes. The movement in deferred taxes. So with this scenario, if we have our adjusted current tax to be, let's say, 2,000, then the movement in deferred tax would be what? 3,000 assets. 3,000 what? Asset. And if it is an asset, it's not a liability, so it's not something that we are going to pay. So if it's an asset, then it means we have to reduce whatever we are paying by the asset. And in this case, we will be getting a refund of how much? 1,000 cedis. Instead of a liability, we'll be getting what? A refund. But the other way around, when it was a liability, a 2,000 liability, when it was a 2,000 liability, it means that the movement is a liability of what? 1,000. The movement is a liability. 1,000 has come to add up to the 1,000 that we had, and it is now what? 2,000. It is now at 2,000. So in that case, the movement would have been a liability of what? 1,000. A liability of 1,000, making the whole payment to be what? 3,000. Making the whole payment to be 3,000. So basically, this is the idea of the deferred taxes and the current taxes. So if I want to recognize in my P&L, I'll just recognize this tax liability of what? 3,000 in my P&L or the income statement or the income statement. Please, if there's any challenge, you can put it in our comment section. We will try as much as possible to make sure we reach out to you. But I just want you to get it well, in especially the movement, because you can't dodge IAS 12 when dealing with what? Financial reporting. No, you can't dodge it. You can never dodge it. So let us take a scenario. Let's take this scenario. There's a scenario I want us to look at so that we can deal with it. Okay. So there's this scenario I want us to look at. Now, we say the following trial balance relates to Kusi Limited at 31st March 2023. So this one, we only have the deferred tax and then the current tax, right? But let's see how we are going to deal with it. We have a deferred tax at a credit side of 27,000 and the current tax at a debit side of what? 5,400. A current tax being at the debit side simply means that it is an asset. So we have to take it out from whatever we are paying today or whatever we are providing today. That is the explanation we just gave. Now, Kusi estimates that an income tax provision of 122,400 cedis is required for the year ended 31st March 2023. And at that date, the liability to defer tax is what? 42,300. So initially last year, we had a deferred tax of 27,000. We have accumulated 27,000. But this year, it has gone up to 42,300. So what is the movement? The movement is the difference between the 42,300 and the 27,000. Or it's a liability. So the movement in the liability, it has increased from 27,000 to 42,300. Now, in our current tax, if you look at our current tax, we are supposed to pay 122,400, but we have a certain asset from previous year. We over-provided in previous year, and it has been given to us as an asset. So we have to less it from our payment today. So let us go to our board and see how we are going to analyze this scenario. Let's break the scenario down. We have deferred tax of 27,000 from previous year. And then we have current tax, but it is 5,400 assets. 5,400 assets. So what will be the current tax that we are going to pay? And the current provision. So the current provision that we have is 122,400. And then the deferred tax for the year. So this year, the deferred tax has gone up to 42,300, right? So our current tax is what? 122,400. Then we adjust with the over provision. Adjust over provision of what? 5,400. So what is going to be our current tax? We have 122,400 minus 5,400, which will give us 117. Sorry, we have 117,000. Then what will be the movement in our deferred tax? So movement in deferred tax. Movement in deferred tax. Movement in deferred tax is going to be last year it was, or this year we have accumulated up to what? 42,300. So deferred tax based on what? Our notes is 42,300. That's the accumulation for this year. But up to last year, our deferred tax prior years was up to 27,000. So the movement in terms of the liability is 42,300 less 27,000. And that gives us 15,300. 15,300. 15,300. So what are we going to recognize in our P&L? So in our income statement, we are recognizing adjusted current tax. Adjusted current tax of how much? 117,000. And then movement in deferred tax as how much? Movement in deferred tax as 15,300. 15,300. So plus 117,000, which will now give us 132,300. So this is what we will recognize in our P&L. The question is, what are we recognizing in our financial position? I think we did explain that. So what we are recognizing in our financial position, as we know, is what is in our note, what we have in our note. For deferred tax, what we have in our note for current year, so up how much we have accumulated up to the current year is what? 42,300. And that will be the deferred tax in our financial position. In our financial position as a long-term liability, right? As a long-term liability. However, our current tax is only going to be what we have in our notes. That is our current provision. Our current provision. In that case, that is 122,400. 122,400. And basically, that is going to give us what? A current liability. Current liability. So basically, this is all about the recognition of your taxes in your financial statement. It's really not difficult at all because the principle is very simple. So once you go through the principle, know how to calculate for your deferred tax as we showed the last time, and also know how to calculate for your current tax as we had the last time, that will make things what? Very simple for you. Normally, in a standard question, it is going to be how to calculate for your deferred tax, right? But you may also get a question whereby you will have to calculate for what to show in the financial position and what to show in the P&L, like what we've done here, like what we've done today. So try out as much as possible to get the principles well. And once you know the principles, things are going to be very easy for you. So today, this is where we call the session close. And before I go, I want to say kindly like, subscribe, and then share our videos if you find them interesting. Once again, my name is Edward, and you can call me Ed. Here is pros and cons accountancy tutorials. Bye-bye.